everyone, this is Demo Gonzalez of Heartwood Financial Services. Hey, thanks for watching. This is our latest market update and outlook video. Now, we've been going through quite a roller coaster ride with the stock market, as you can see here from my graphic. In the beginning of August, we were way down, and then it kind of came back up, pretty much right back to where it was before it went down in late July, and now we're starting to go back down again here in early September. So what in the world is going on? Why are we seeing so much volatility? And is this a new trend that's going to stick around and maybe get worse, or is this just a temporary trend? So we're going to talk about that and a little bit more. And so I hope you guys enjoy, and thanks for tuning in. All right, here are the asset class returns for the month of August. As you can see in the green, year to date, pretty much everything is up. So it's been a pretty good year so far. The blue is for the month of August. Despite all the craziness that happened in the month of August, you probably heard in my last video, we highlighted some of the things that were happening right at the beginning of August, which affected, of course, the month. We still had mostly a positive month. Large cap was up 2.5%. So was developed international. Emerging markets was up too, not quite as much. But the big winner for the month was real estate. Look at that, 5.79%. Now with the Fed coming out and saying we're going to start to lower interest rates, that's having a nice positive effect on real estate and also in the fixed income areas. Up 1.63 for just your aggregate bond. High yield was up as well, 1.53. So the downward move was in small cap stocks. We're starting to get a little bit of a growth scare here. We're going to be talking a lot more about that in the market update. And so with the growth scare, you're seeing the small caps, which tend to be a little bit more sensitive to the economy, took a little leg down. And so last month they had a big jump, but this month, well, maybe it's not going to stick. Maybe later in the year that will happen, but not quite yet. And then last thing was the commodities. Commodities were down, but of course, this is the whole commodity complex. This is not talking about gold. Gold is actually up, which is what we have in our portfolios. So gold was up nicely about 3% and has been doing really well year to date. One of the best asset classes so far. All right, so there is no denying it now. The growth of the economy is definitely slowing down. Now the argument is, of course, it was slowing down from a higher growth rate to maybe a more normal growth rate. And so that's part of the debate. Are we going into something that is slow, or are we just slowing down from something that was maybe unsustainable? Well, here's some of the numbers. When we look at what happened with the main economic indicators, I like to look at the ISM numbers. This is an organization that does a big survey that looks at the manufacturing world and the services world. And they're a little bit of a conflict right now, which is pretty normal when things are kind of getting back to normal and slowing down. The manufacturing numbers were at 47.2. So anything under 50 means things are contracting. So that is not a good sign. That is pretty well below 50, and it's been consistently below 50 for several months now. Now on the flip side, the services number is actually still pretty good at 51.5. And it's been over 50 for several months now. Now it hasn't been over 50 every single month this year, but for most of the months it has been. And that our economy is still 80% services. That's a pretty big deal. Now we also had the unemployment report that came out just last Friday. And it came out a little disappointing, but it really wasn't too bad. It was 142,000 new jobs. And the unemployment rate, instead of going up like it has over the last several months, it actually ticked down a little bit to 4.2. So it doesn't sound too bad. The downside, though, is that they had these big revisions for the previous months. So the previous months were actually even worse than the slowdown that we were seeing. So we're definitely seeing the unemployment or the employment and labor situation starting to soften. But it doesn't look like there's these big, massive layoffs. It just looks like companies really just aren't hiring as much as they have been. All right, and then the other big news that came out in the month of August was the PCE report. If you remember, I talk about this one a lot. This is the inflation report that is the favorite one of the Fed. This is the one that they focus in on the most. And the latest PCE report showed inflation at 2.5%. That's, again, slightly lower than it has been in the past. So getting closer to that 2% target. And at this point, I mean, it's pretty darn close, right? We were almost double digits just 2 years ago. So the fact that it's come down this much is a very, very good sign. And you're starting to finally see the Fed, okay, I think we finally seen enough that we're going to start to lower interest rates. So we'll talk a little bit more about that here in a minute. Now, last month I highlighted this yen carry trade. I don't want to bore you with the details again. Go back last month and watch the video. But basically, I'm still monitoring this, and the more the dollar goes down versus the yen, the more this risk pops up again. And as you can see here, it has kind of stabilized here in the month of September, August, and September. But recently it has been going down here a little bit again. So I'm keeping an eye on this because this could rear its ugly head again. But so far it seems to be cooling off a bit. So despite all this potential weakness and this potential for a recession that some people are concerned about, which is legit and it is still a probability, why is it that the market has been holding up? Well, one of the reasons I feel that is because earnings has been holding up. And the estimates, which of course could be wrong, but these analysts, they do a lot of hard work to try to figure out where the estimates are going forward, are showing that the estimates are actually going up. You can see the light blue shows the estimates are actually improving over time. And so as long as the stock market sees their earnings are still strong, they're not dropping, and in fact the estimates are still looking better and better and better, that actually gives the stock market a little breathing room to potentially hold up during these times and maybe even still continue to climb a little bit more. All right, I do like to bring up sentiment every once in a while. It's very interesting how this works. Sometimes sentiment can be a contrary indicator, meaning that when everybody gets a little too excited, that means the market is kind of already at a peak. But sentiment is a sign of definitely how people feel about the stock market right now. And as you can see, the latest sentiment numbers at the end of August show, here's the green, shows a lot of people are very bullish versus how much they were bearish. And on average, the bullish is about 37%. So we are way above here at 37.5. We are way above the normal bullishness for the stock market. So maybe there's a little bit too much of that. We'll have to see. But that is definitely helping also to keep the stock market at these price levels, even when we're starting to see some chinks in the armor like we talked about last month. All right, so what is the Fed going to do with all this? Inflation's starting to go down, but we're starting to see some cracks in the economy. Well, here is what the CME Group, which does extensive research on the futures market, thinks is going to happen by the end of the year. So right now the Fed funds rate is at 5.25 and 5.5. And as you can see here, the highest probability is that it's going to be somewhere around 4.25 to 4.5. That is 100 basis point or 1% less than where they are today. So right now, the market is pricing in 1% in cuts. And there's only 3 more meetings. So there is potentially some big cuts coming our way, which would definitely give us a tailwind for the stock market, especially towards the end of the year and into next year. So for the outlook, I believe that we are currently in the growth scare time of the market. So the market's looking at things slowing down. It's getting a little nervous. Every time you see one of those economic numbers show some weakness, the market has taken a pretty big dive. It's not looking at inflation as closely as it used to. We were talking about inflation almost every month over the last year and a half, but now it's more about the economy. And so every time there's a little growth scare, we're seeing that hiccup, that little indigestion, and I think we're going to continue to see that here for the next few months. All right, so continue to prepare yourself for more volatility here over the next month or two. The Fed's going to start cutting rates, but they may not cut the right amount that the market wants them to cut, and then all the political stuff and pre-election stuff that's going to be hitting the news wires, it's going to add a little bit to the volatility. And that is pretty typical when you look at election cycles. September and October tend to be more volatile, sometimes a little bit more down, but then November and December things kind of pick up again. So expect the volatility here in the next month or so. All right, and to finish up the outlook, I wanted to show you this last slide that shows the performance of the S&P 500 going back to 1945. All right, and it shows the different combination of different parties that have been in charge of the U.S. government and how it has performed annualized over that 4-year period. And just in broad strokes, when you look at it, you could see that the best performance has been when there's been kind of a combination between Congress is split or Democratic or Republican president. Pretty interesting. Now, interestingly, one of the best performers for the stock market has been a unified government that's all Republican as well. That is the one exception to this whole gridlock scenario. Now, I don't know what's going to happen this election cycle, but I think most people can agree, because we have both sides thinking that they're going to do pretty good, we're probably going to have a mixed government. In other words, not a unified government. It's looking more and more like that. And the point of bringing up this slide is that when we have a non-unified government, which causes gridlock, it is usually pretty good for the stock market. All right, let's sum this all up. Here are the Heartwood implications. Now, basically, this is the same chart I had last month. I haven't really changed anything. I'm still slightly bullish because we're mostly in this soft landing camp where we don't think there's going to be a recession. But because there's a potential for that, we are aggressively rebalancing. In other words, right now, we're kind of selling the stuff that's done a little better, which has been stocks, buying a little bit more in bonds to add that little cushion in case there really is a recession or that scares a little worse than I anticipate. So we are doing that, but for the most part, we are leaning into a little bit into the stocks because we do feel that towards the end of the year or early next year, things are going to start getting a little bit better again. So we're adding from cash into stocks. Right now, still playing it kind of safe, adding to the large cap stocks, mostly income-focused stocks. But we are making our shopping list of things that we do want to get into once the economy starts to get out of this little growth scare, and we'll be reporting on some of those changes here in the coming months. All right. Thanks, guys. Thanks for watching. Please feel free to share this video with your friends or anybody that is asking you questions. This is probably more pertinent and relevant information than you're getting from the media, even from the financial channels, and oftentimes even from other financial advisors. So feel free to share this. It would make me very happy if you did that. And of course, thanks for watching and God bless. Bye-bye.